Recording in progress.
Hi, everyone. Thank you for joining me for part two. So today, going to give a little bit more information and consideration of how I think technically I've created my own first lien HELOC, and I will be working through it. So here, prior to getting the home equity line of credit, I had 3 properties with 3 mortgages remaining on the properties. First property, when I started in January, when I was trying to get a first lien HELOC to wipe out all of these properties, I was unsuccessful. So at the time, I think I was trying to get a mortgage of, well, a HELOC of $147,000 that would have covered all 3. So I was looking for actually a first lien HELOC at about $150,000. Now, if I would have been successful at getting this HELOC at $150,000, that would have wiped out all 3 mortgages and then put me in a simple interest loan as opposed to a amortized loan in which the loan amount every month is already set. There's just different percentages of the principal and the interest that I'll be paying. So I took a HELOC out on property 2 for the $50,500. And no, I'm sorry. Yeah, the HELOC was placed on this particular property here. So this property right here has the HELOC as a subordinate loan. So the primary lender was Wells Fargo. Then I went to another lender to get the HELOC of 50,000, and it's behind Wells Fargo's first lien position for the mortgage that it was carrying. Well, still carrying at about $28,000 now. So I was able to borrow against this particular home, but it still already had $32,000 on it, and I added $50,000 onto it also. So this home's here has a subordinate loan. So 32,000 plus the 50,500 is setting on this particular house here. So it is in the second position, but I'm trying to treat it like it's in the first position because it fundamentally wiped out this third house. So if you read various definitions of first lien HELOC, they fundamentally wipe out an existing mortgage, and then this becomes a line of credit. When I went to the Consumer Financing, I think, Bureau of the US that was established after the 2008 market crash, they call the first lien HELOC a second mortgage loan. So it is a loan, just like the first mortgage is a loan. So now that this 50,000 wiped out this 32,000, I'm now paying on the HELOC for the first phase because it has 3 phases for this particular HELOC. So for the first phase, I'm able to draw money from the HELOC for 1 to 3 years. So I can put money in, take money out, put money in, take money out. But by the 4th year, I need to start only making interest payments. So I can no longer take money out of this particular HELOC. Now, there's a number of different other HELOCs, but for the one that I think I was blessed with, I was happy with, I just ran with just to get started. 1 to 3 years. The second phase will be 4 to 7 years. And then the third phase will be 8. It's gonna be 20 years on that phase. That's gonna run from 4 to 10. And then 11 to 20. 11 to 30, I'm sorry. So again, in the first phase, I can draw money from it and take it out. I can get money, go in, go out. I can pay it down, pay it up. Like right now, it's at 45,144. I can take money out of it, which I am doing to pay some bills, and I'm gonna show that later. In this second phase, I'm just starting to pay them interest, and I can throw some more money toward the principal. Now, in general, so this last period, the last 20 years, I will be required to make whatever the principal payments and then interest on top of that. So it's going to be the same thing here, and it's going to be required. I won't be able to take any money out. I won't be able to take any money out at all. So the way that I was thinking about it as a first lien, I was able to wipe out this mortgage altogether. I no longer have a principal and interest payment to the bank, but I still have this $50,000 that has to be paid off, and the 37,000 from here is just fundamentally inside of the 50,000. So one of the things that I was basically saying is, okay, will a $50,000 principal line of credit be able to beat a amortized fixed loan, all things being equal, except this has a 10.25 variable rate that can range from 4% to as high as 18%. Even if I had to pay 18% per month, it still will be lower than what I was paying on this home, plus the car that it paid off, one pledged loan, and in addition, 2 credit cards. Okay. All right. So if this HELOC goes up against me to 18%, that's the only thing that it can cap out at. I will be end up paying about 700, and I think I calculated at $33. Before the consolidation of the bills and the debt, I was paying $950, I think, for all of the debt that it wiped out. So from what I've seen on the internet with velocity banking, there's the idea that you can beat the interest rate and putting your entire paycheck into it, paying your bills from it. In general, it may be better than an amortized loan. Now, I did it with credit cards in a sense that I first put a few of my bills into the credit card, paid it off. I kept some of the money in the check and paid my rent, mortgages, and other things. Then a couple of months later, or a month later, I was able to just throw everything into the credit card that I was trying to pay down and pay my bills out of it using convenience checks. I also use a system of having a shell checking account. I don't know what that system is called. So when I write a check, it'll pick up some of the money, but then the rest will be placed on a credit card, and I use that to stretch my money a little further. and cash advances from also one of my credit union, which was at the same rate as the convenience checks. I was paying about 92 cents per day for those lines of credit, but it significantly helped me to pay down the credit cards. And then once I was able to get the HELOC, I was able to do away with all of that. Now everything is paid through the HELOC. My mortgages, these two remaining mortgages, my rent in the apartment, um, gas, food, clothing, basically treat it like a credit card, but for this one I had to write checks. There are again other HELOCs that are electronic, but the one that I have and I started with paper, and I've just been running with it. So to recap, I'm trying to treat this 50,000 HELOC like a first lien HELOC because it did wipe out one of my mortgages, and I'm just going to see by making my payments, can I beat it in general and save money? There's risk in it. The primary risk is myself. Now that I have saved at least 200 and some dollars, if not more, what am I doing with that money? Am I going out, spending it and doing other things with it? No, I'm kind of piling it back into the HELOC. I can also lose my job. This HELOC is a mortgage on top of this house. I mean, I'm sorry, of this house. So if I don't pay it, they can foreclose on it. But I still got to figure out how they can go through Wells Fargo as the first lien. But I think they can start the foreclosure process or something to get their money if I lose my job and I can't pay. Third, if I'm undisciplined and I'm not doing the things that I need to do to make this work in general. But I'm trying to live below my means, enjoy my life, and use these properties as assets in terms of how I live my lifestyle, in terms of my other businesses in general. So that's it. I'll continue to learn more about the first lien HELOC and continue to bring you more information about the first lien HELOC. Technically, I do not have a first lien HELOC, but I'm trying to treat this like a first lien HELOC because it did wipe out this mortgage, and now I just have this line of credit that needs to be paid down. All right. Oh, I'm sorry. The third phase. All right. So thank you very much for joining me. And that's my basic understanding of a HELOC, first lien HELOC, as I move to continually understand it and to use it. All right. Well, thank you very much for stopping by. Have a great day.